Government accounting isn't just about local currency. In today's world, governments receive grants in dollars, buy equipment in euros, and manage projects across borders. This creates a mess of currencies and fluctuating exchange rates. Enter Ipsas 4. The effects of changes in foreign exchange rates. Think of it as a universal translator for public finance, ensuring governments handle foreign currency transactions consistently. Without Ipsas 4, comparing financial health across countries would be chaos. The standard tackles the real problem: exchange rates constantly change, creating gains or losses that impact budgets. Ipsas 4 gives governments the tools to measure, record, and report these changes accurately. We'll break down the essentials: functional currency, recording transactions, handling exchange rate changes, and real-world examples. By the end, you'll see how Ipsas 4 brings clarity and honesty to government financial reporting, no matter the currency. Before dealing with foreign currencies, you need a home base, your functional currency. Ipsas 4 defines this as the currency of the primary economic environment where the entity operates, usually the national currency. It's the currency that drives your revenues, costs, and daily operations. To determine it, look at what currency influences your prices, costs, and regulations. Once set, every transaction not in this currency is a foreign currency transaction. For example, a Kenyan agency with the Kenyan shilling as its functional currency must translate all euro grants into shillings. Locking in a functional currency ensures consistency and comparability over time. Without it, governments could manipulate results by switching currencies. Ipsas 4 makes sure financial statements reflect economic reality, not creative accounting. The functional currency is the bedrock of transparent foreign currency accounting. Let's get practical. When a foreign currency transaction occurs, Ipsas 4 says, translate it into your functional currency using the spot exchange rate on the transaction date. For example, if a ministry receives a $100,000 grant and the rate is $1 = 5 LCU, recorded as 500,000 LCU. The journal entry? Debit cash or receivable, credit grant revenue, both in LCU. This principle applies to all foreign transactions, purchases, grants, loans. The initial translation sets the historical cost for assets and the value for revenues, expenses, payables, and receivables. It's the starting point for all future changes. If a department buys equipment in yen, it uses the spot rate on the purchase date to record the cost in its functional currency. This ensures every transaction is captured at its true value at the time it happens. Ipsas 4's approach keeps financial records accurate and comparable. Every foreign transaction starts with this translation. It's the foundation for reliable public sector accounting. After initial recording, exchange rates can change before settlement. Suppose a ministry records a $100,000 receivable at $1 = 5 LCU, 500,000 LCU. A month later, the rate is $1 = 5.1 LCU, so the ministry receives 510,000 LCU. That extra 10,000 LCU is an exchange gain, recognized in the surplus or deficit. If the rate had dropped to 4.9 LCU, it would be a loss. Ipsas 4 requires these gains or losses to be recorded as part of financial performance. The journal entry at settlement reflects the cash received, the removal of the receivable, and the gain or loss. The same logic applies to payables. If the currency strengthens, you pay more. If it weakens, you pay less. Managing these fluctuations is part of sound financial management. Ipsas 4 ensures these real impacts are visible in the financial statements. Exchange rate changes aren't just accounting, they affect real budgets. Accurate reporting keeps governments accountable. What if a transaction isn't settled by year-end? Ipsas 4 distinguishes between monetary and non-monetary items. Monetary items like cash, receivables, and payables are retranslated at the closing rate on the reporting date. Gains or losses go to surplus or deficit. Non-monetary items like equipment or inventory stay at their original translated cost. For example, if a grant receivable is still outstanding at year-end, it's revalued at the new rate, and any gain or loss is recognized. But equipment bought in euros remains at its original value in the functional currency. This distinction ensures only items tied to cash flows reflect exchange rate changes. Ipsas. Four's rules keep year-end statements accurate and fair. It's a simple rule with a big impact on transparency. Understanding this split is crucial for correct reporting. Governments often have foreign operations, embassies, agencies, or branches abroad. When consolidating, all assets and liabilities of these operations are translated at the closing rate, even non-monetary items. Income and expenses are translated at the rates on transaction dates, or an average rate if rates are stable. This process creates translation differences, since different rates are used for the balance sheet and income statement. These differences aren't recognized in surplus or deficit, but in a separate equity reserve. It's called the foreign currency translation reserve. This keeps operating results clean and reflects only the impact of translating an entire operation. Ipsas 4's method ensures consolidated statements are accurate and comparable. It's essential for governments with global activities. Transparency is key. Ipsas 4 requires clear disclosures about foreign currency impacts. Entities must disclose exchange differences recognized in surplus or deficit, and explain how much of the result is due to currency changes. If the functional and presentation currencies differ, this must be disclosed along with the reasons. Translation differences recognized in equity must also be explained and reconciled. Additional disclosures, like risk management policies or sensitivity analyses, are encouraged. These rules help users understand the real impact of currency movements. Mastering Ipsas 4 is about more than numbers. It's about clear, honest communication. Check real-world financial statements to see these disclosures in action.